All right. Good morning, everybody. So we're doing the thing again. What we're looking at right here is the SPX against CTA positioning. I show this from time to time, kind of give you an idea of what the CTA funds are doing, and it's worth considering what they've done in the past and this current behavior. So they don't they don't stick around and ask why, right? They just GTFO and worry about it later. If you look back at some of their previous exits, they were well timed, right? Here, here, and say at the start of the new year into the April capitulation and the reversal. So if you was to look, put some lines on it, start mapping it out, a lot of times they're early and there's some additional pullbacks or exits that didn't really materialize in price action, like back here, where they dumped drastically, but the market really didn't go down that much, or here when they dumped and the market just kept right on going, so they piled back in. So you got to kind of take it with a grain of salt. Yes, they move a lot of money, and they often end up being right, but not always. So if you look earlier this year, they dumped out at this point and the market barely went down at all and just kept right on going. So they had to pile back in plus some. And then they started dumping again and the market's still going, right? And we're getting this tiny little rollover up here. Now, are they reacting to something that we don't know and going to turn out to be geniuses who got out before it all dumped? Or is it like this previous one where they got out and the market kept running and then they had to pile back in to chase after it? There's really no way to tell, right? There's a lot of warnings and that's what they respond to. They don't care if they miss something. There's a lot of warnings, there's a lot of risk, and so they de-risk. That's the idea, right? You don't have to get out of everything. You just want to de-risk a little bit. If you've got trades that are in profit, take some off. If you got trades that are struggling to perform and they're still kind of near a break even, maybe just get the heck out of them before they get negative, right? Or they get really negative. Just know what you own and consider reducing your risk some. That's what this represents. And they don't care if they got out and it continued to go higher because they were still in. They didn't get completely out. And they just added back in and made money anyways. The CTAs hold everything, right? If you was to go and just Google what are CTAs, who are they, what do they represent, and what do they trade? They trade everything, right? So there are nuanced things that they do, and there are nuanced groups like VC funds, CTA funds. Um, each one of these specific funds have a particular thing that they like to dig into. And if you've gone through the commodity report, the COT report, commitment of traders report, do some work on that and it'll help line you up on the CTAs. But at the end of the day, these quote smart money places are not smart money, right? They happen to have more information than you, or they have a lot of analysts on staff who can do a lot more research than you. And so they're ahead of the game just because they happen to have seen a headline or they know of an event that's coming that's public knowledge that we don't happen to know about. So, due diligence, I guess, they have more diligence. But if you get to meet some of the people that are quote CTA advisors are a part of that smart money and talk to them for a little bit, you'll realize that they don't know very much at all. They have their little niche, their specialty that they do. Maybe they're bond geniuses and they can't figure out, what a CCI indicator is or a MACD or something, right? Or they can't trade an option other than to buy a call or a put. That they don't know anything beyond their own tiny little niche thing like fixed income or bonds or whatever it is that their niche spot does. You can try to suss out what they trade and then piggyback them, and people have done it over the years. That's why they've cried foul, and it's why the dark funds do so well, right? The dark exchanges, so that these guys can get their work done without people front running them, because they cry when people do that. So looking at what's going on today, got Hong Kong basically flat, S&P, NASDAQ, small caps, Dow, all of it down there, less than a quarter, just waiting. We're continuing to see Japan front and center, and gold is the thing. Everybody's looking at gold. Everybody's talking about gold. It is the signal of risk at the moment. So keep your eye on gold, because once it goes, I think this whole thing goes. Then we get into Europe, Germany. For what we have on the table today, we've got the 10-year auction. We get FOMC minutes. And we have crude oil inventories. That's the big thing for the day, those three things. Of course, we got some Fed speakers chipping teeth. Maybe we'll get headline news out of the White House about the shutdown. There's that looming over us the whole time. But we're not expecting anything out of any of these Fed speakers. They're all just chipping their teeth, saying the same thing that they've been saying. It's possible we could hear something out of Europe today at 11. I don't think we will. No, never mind. It's a pre-recorded video message. The 55th anniversary event in Luxembourg. I caught that much. I don't know what that says, but it's nothing. If it's pre-recorded, then it's just platitudes and blah, blah, blah. Nothing. So the 10-year, and then FOMC. Now, these numbers are off, right? We would need to swap this. There we go. That looks better. FOMC minutes at 2 o'clock. 10-year note at 1 o'clock. 10:30 for the crude report. Crude isn't as impactful now as it was 15 or 20 years ago, but don't sleep on that 10:30 report. We will go months without that report having any impact at all, and then just out of the blue, surprise. So just keep your eye on the clock. Don't let that one run you over. I don't expect anything to really come out of it, but I won't turn my back on that data. The bigger one for me today is the 10-year note. Even the FOMC minutes aren't really all that exciting. And inevitably, there's always some new guy who thinks that this is FOMC, right? If you're new to trading, this is not FOMC. This is just the minutes, right? Big difference between those two. Goldman Sachs was calling for gold to be at 4,900 by the end of the year. They put that out yesterday. And I didn't catch it, but there was some something going on with U.S. Venezuela, and talks about perhaps escalating military involvement. Not sure what that was about, but keep your eye on out for those headlines. The move may lead to further military escalation. Trump has called off U.S. diplomatic engagement with Venezuela. I don't know, right? That was yesterday afternoon. So the Nasdaq looks like the S&P. They both have that drawdown. Gold, they're still chasing. As we mentioned last week, there's a lot of room to get back to their previous position size. Silver, they're running neck and neck. They are holding more now than they've ever held on that chart. I don't think that's all-time positions, but you could dig out, probably Google that one. All right, so yesterday we had an outside bar. We just wicked above and below Friday's levels. And now we're back inside, and we're still inside Friday's levels. So we are in a confirmed IX10, but it's not an exciting one when it's a really big bar. A lot of analysts won't count this as an IX10 either because we left the range, and they won't care that we came back in the range. Now, there's no wrong way to go with this. I think being too strict on the rules really eliminates a lot of patterns that you would have traded. So I still consider us to be IX10, and we're still in the range. At the most, you could consider updating everything and focusing on the new outside bar and let that be your new range. There's no wrong way to go with that. Yesterday's midpoint, 67.75, and we're hitting it, right? We hit it last night. It's where we kind of topped out. I don't know why we got a cog line at 75. Probably an options level. We're still above the volatility trigger, well above zero gamma. We are 50 points away from zero gamma. The put wall rolled up, which is why I shared the picture of the put wall, call wall. I only share that if the call or the put wall moved. Otherwise, I don't bother with it. Yesterday's low today is the 10-day moving average. Yesterday it wasn't, right? Because the 10-day has been moving up every single day. And today, when it moved up, it's now matching yesterday's low, which is also where the weekly pivot point is at. That's what we bounced off of yesterday, is the weekly pivot point. We got 59,000 in the overnight, so volume is normal. Nothing really stands out there. Looking at the ADR lines, we can hit the upper ADR a lot easier because it's inside of yesterday's range. All we got to do is get through the midpoint and we can hit 6792 cog line, which is the ADR here. If we can get through that, then we've got 6800, which is also a big options level. And I believe it's a big level out on the daily too. That's Friday's high. So it's last week's high and a big options level. Just because we can hit the upper one easier doesn't mean that that's where we're going to go. In fact, we are building a really large bear flag. I'm not excited about these type of bear flags. I know that they're all over the textbooks, and they always make it sound like it's such a great trade. To me, they're not. And one of the things I don't like about them is how long the flag is. And if you want to call it a pennant, you could call it that to a bear pennant. But this should not have gone on for so long, right? One of the things that I tend to focus on is what the patterns are supposed to represent. In a typical bear flag scenario, you had a decent trend to the downside, and then you pulled back because people took profit, and others happily took their place, and you continue to the downside. Now, in that pullback time frame, digesting for a little bit and just kind of putting it on pause is usually where you get that bear pennant or bear flag. That's fine. But it shouldn't have come higher than a 786 level, and it should have resolved relatively quickly and continued to the downside. And the fact that it didn't kind of takes a lot of that bearish bias off the table for me. It's not to say that we can't continue to go down. It's just I would have expected the bears to press their case while they were in control, and they didn't. So now we've got this tug of war going on, and we're fighting the midpoint. We have to get above this midpoint and then keep it. If we just poke above with that nice little evening star reversal we just had here, what a beautiful setup. I love that trade. But if this is the kind of shenanigans we get, we're not going to keep it. We're going to get on back down again. We got to get up there and stay up there if we're going to do anything else. And the longer we stay below here, the more likely it is we're just going to break this low of yesterday and continue the expansion to the downside. As I mentioned, we hit the weekly floor pivot multiple times yesterday. Now this floor pivot, if you was to go and Google floor pivot, you'll realize it's just a math formula, right? They take the open, the high, the low, and the close, and they normalize that. They add them all up and divide it by 4. Now, some pivots, they just use the high-low close, and of course, to normalize that, you would do it by 3, since you're just using the high or the low or the close. 3 objects, divide by 3, 4 objects, divide by 4. That's all it is, right? It's just math. Well, this is a weekly line, so it was using the weekly, last week's open, high, low, close. And if you was to get your calculator out and go out to a weekly chart, just take your time and mark out those with a line that has the numbers on it. And I bring this up because if you want to use these tools, it helps if you understand what the heck it is you're using. Put it so you can see the number. Put all 4 of those into the calculator. 6,800 plus 6763 plus 6697 plus 6680. Once you've got all 4 of those added together, divide it by 4. Why are you dividing it by 4? Because there's 4 objects. And because you did that on the weekly, you would get this weekly floor pivot. Other analysts will just use the high-low close. They won't use the open. So if you was to get rid of anything, get rid of the open, and then just add these 3 numbers together and then divide it by 3. Right? That's how you get the floor pivot. Now that calculation works for anything. If you want to do a floor pivot for an hourly candle, a 30-minute candle, a 30-second candle, whatever, it doesn't matter. The math is the math. It doesn't mean you can't do it, right? All these other lines that we're looking at, S1, R1, S2, R2, all of these are also, they're just math. So if you was to go to Google and type in extended floor pivots, you will find those calculations too. Now we're using the daily ones in this chart here, not the weekly. The only weekly I have is this line down here. I don't calculate SNRs for weekly. So hopefully this gives you a better idea what the heck these lines are, where they came from, and what to do with them. Today's floor pivot is lower than yesterday's. That's bearish. Price opened underneath it, and that's also bearish. We've cut through it multiple times, so we have no missed daily pivot here to worry about. The channel's a little wide. It's not as wide as some of these that we've seen in the past, but a wide channel implies that if we break out, it doesn't stick and we go back in again. The channel looks maybe a little bigger than yesterday's, not by much, but a little bit. And yesterday is not what I would really consider a narrow channel, but we broke out, and for the most part, we kept it. Right? Maybe we got just barely back inside the line by the close, maybe, depending on if you want to count the close at 4 or at 5. And technically, it is 5. So we barely got back inside the line. I think that's just pulling strings, though. There really isn't much of an expectation that we're going to do anything today without the headlines to move us, right? So you want to continue to keep your eye on gold and treasuries. They're going to be your quickest access to something changing. If you're looking for a tell or an indicator that things are beginning to get nasty, you got the 10-year, the dollar, and gold. Those would be really good tells. So maybe just swap that ES out for something else. Otherwise, keep your eye on the 0-day flows once we get into the trading days. See if market breadth has anything to offer. All right, that 67.50 held this time, and it held last week when we tagged it Thursday into Friday. I don't know how many more times that 67.50 is going to hold, but for the moment, it's holding up relatively well. Underneath 67.50, we have 66 50. Remember, we're running 50s, not hundreds. So while we could expect a pause at 6,700, if we lose 6,750, 6,650 is the goal. The last time we were at 6,750 and we lost it, we went to 6,650. Then we came back up, and since we've made it above there, we've been staying above it. But that's now the line in the sand. And if we can get back above 68, then 68.50 is the next stopping point. I don't make the rules. $10-day, 30-minute volume profile in TPO. The point of control has moved. I seen a really good AI commercial yesterday. It was just one of these little short and sweet commercials that was like, the world's got a lot of problems. Find your problem and be the solution. AI. I don't remember which AI it was. It doesn't really matter, right? At the end of the day. But that was a really good commercial. So we got the point of control moved, and we're not above it as much as I would have liked to have seen. Instead, we're at the point of control. And while we're at it, we can just cross back and forth like it's not even there. So don't expect it to be support or resistance or anything like that. Not even really a magnet. We're just going to cross back and forth through that level, building out more and more volume at this spot. It will only begin to act as support or resistance if we leave the zone and then come back to the zone. We got this shallow area that we've been talking about. That would get us down into 6,700. If that doesn't hold, then 6,650 is on the table. They were giving some stats on how many people are using AI daily. It was some pretty big numbers. I got to remember where I saw that stat, because they're monetizing that like crazy, right? Just the average Joe Schmo who has a subscription to AI services, the numbers were eye-popping. And even if they're just $10 subscriptions a month, right? They don't even have to be the expensive subscriptions. It was eye-popping. But they're spending money hand over fist trying to get the data centers and everything else. So they're not making money, right? They're bleeding money. Yesterday's VPOC is gone. We've hit it. But this is one of those scenarios where I highly recommend carrying that line across. You know what really surprised me is they were talking about OKLO, not picking on them, but the SMRs in general, and how the US doesn't even have one. And it's nothing more than just talk, right? They don't even, there isn't one. What the heck is the all the money going into OKLO doing? Because it's not investing in a company that has a active running product. That might as well just be a SPAC, right? All those SMRs. I'm not poking on OKLO. This point of control from yesterday should be carried forward, and it's not a VPOC because we've already hit it, but there are days sometimes where it's worth carrying forward the previous day's point of control. The textbooks will tell you to do it every day, and I don't do it every day, but just there are times where it's worth having it on the board. So I would put that one on the board for today. You could just look at it as the pivotal spot between all of this profile yesterday, this biggest volume structure. This level is more important than yesterday's low. That is, call it 67.60 if you want to just round up to an easy number, because I promise that 1 point ain't gonna make no difference, right? Looking at the weekly expected move, whatever the market was pricing in for this week, it hasn't happened yet. Remember, they widened out the weekly expected move in the anticipation that we were going to get some real expansion. And so far, we have not. There's a little bit of a warning tucked in there. Either A, whatever they thought was going to cause us to happen didn't happen. And so we just didn't make the move. Or B, it hasn't happened yet. Now, I don't even know why they made it wide to begin with. So I can't tell you if it's happened yet. But we haven't expanded, obviously. So either it hasn't happened yet or it didn't cause an expansion like they anticipated, one or the other, which means we want to continue to be cautious and nimble. Don't plant your feet. We're still above the 10-day, just barely, but barely counts. I like being a 0.5% above or below, just sitting in this zone. It's a nice place to be. There's nothing wrong with being in that spot. We're not overbought. We're not overextended. We're not overheated. Pick whatever phrase you like. We're not that. So it's just a good spot to be, especially when you're looking at it in the context of where we're at on the weekly. We're still more than 2.5% above the 10-week, less than 3%, which is good. We don't want to get overheated. There's nothing wrong with where we are, and it's just a good spot to be in. So even with that pullback yesterday, as violent as it may have felt, or no matter how extreme you thought it was, the trend is still intact. We still have a bullish market backdrop. There's nothing wrong with this market in terms of the technical analysis and the health of the patterns and the structure of the price action that we see. If you're shorting right now, it's because you know something the rest of us don't, or you're just guessing and gambling. Speaking of, there was some quotes from Spot Gamma yesterday where they were recommending hedges. You know, I see that word hedge used quite a bit to represent the idea of a short trade. Hey, if you want to take a short trade, take a short trade. And you can call it a peanut butter sandwich if you want to, but it's still just a short trade, right? So calling it a hedge doesn't make it a hedge. It's just a short trade. Hedging is when you have funds allocated long or short that you're carrying in a portfolio, that you've distributed this capital into the market, and now you need to protect it. Generally, that's a long portfolio, but it doesn't have to be. So now you've got all these funds deployed, you're long and a bunch of assets scattered across the market, and you're concerned and you need to hedge, and you're going to protect that divested interest, all those trades that you have on. One put in the queues is not a hedge, right? If you've got $20,000 long scattered from Apple and Microsoft and Nvidia and goodness knows what, buying one put is not a hedge. It's just a short trade. So, you know, if you're hung up on Spot Gamma's post from yesterday and that language about a hedge, figure out what a hedge is, and then try to figure out what they meant by their comments yesterday. Otherwise, it's just a short trade. I run a beta weighted portfolio. So each new trade that I put on balances my portfolio's beta weight. And I try not to get too heavily positive or negative so that I don't have to deploy tons of capital into a hedge. Each new trade I put on is in the perspective of what's my current risk, positive or negative, and so which one am I going to add to get me closer to zero, positive or negative. The VIX is down, although over a 5-day period, it's still up 2.5%. The Mag 7 down volume is down. That's a double negative. Looking at what's up this morning. Gold miners, junior gold miners, metals and mining, Bitcoin, more Bitcoin, a little bit of Bitcoin, quantum, uranium. Hey, we were just talking about those guys. Bonds, China. We've got the ingredients for a rally day today. As we can see, the Mag 7's trying to work its way up. We got some China floating to the top. Bitcoin's getting a little frisky. So we have the conditions for a rally. That's not to say we're going to get that rally. And some of this is a bit stretched. Uranium's already up 6% in 5 days. But it's a good start, right? So if we want to get that rally day today, we want to see more out of the Mag 7. And it wouldn't hurt to bring the broader market with us today, right? Like that rising tide lifts all boats sort of scenario. I do like that meme, that rabbit. I'm keeping that. Yeah, it's a keeper. Oh, that's not even a meme. Did you just have that on your computer? You just hoarding those, saving them up for a special day? It's not a bad idea. All right, miners are kind of topped out. You got to admit, that's a good one. So silver, gold, and miners, they're at the top of the list with pot stocks. And pot stocks are hung up on the half. Then we've got oil, which we have the inventories today. Don't forget Bitcoin, oil again, uranium, bonds, agriculture. What I'm not seeing up here is the Mag 7. Right? Once we've jumped over to TrendSpider, which has a much more accurate morning analysis than Thinkorswim does. Mag 7 isn't in there. They are up this morning. They're just not up enough. And I don't know about you, but that doesn't look very bullish to me. I don't care that it's up 0.25%. That looks bad. So let's get Mag 7 moving in the right direction. And, looking at it on the daily, it's already made one heck of a run. MACD is rolling over. It's still above zero, but we've crossed, right? And, the way that that's read is you're still above zero. So primary trend is still intact, but you've rolled over. So secondary trend is not intact. Secondary trend is in weakness. That would be, primary, secondary would be your time frame adjustments. So we need a little help out of the Mag 7 if we're going to get this rally day. And if it doesn't come from them, it's going to have to come from the 0-day flows or some kind of headline, right? Otherwise, we don't have the sectors, the industry, the market breadth to get us to get this push, this breakout. To be fair, though, this isn't screaming a breakdown either, right? It's not indicating that we're going to just fall out of bed and tumble. So base case argument, we hold the line and we wait on data. And it's very likely that today's data is not the droids we're looking for, nerd. And that we just go sideways. As usual, GTFO, we got to get out of this box. Do that first. If we can get out of that box, then we can challenge yesterday's high and yesterday's low. Get out of that box and we can challenge last week's high with the breakout. Or we can head to the downside and challenge that 6,700 level down here. And, you know, from a day trader's perspective, I don't really care which way we go. Let's just go somewhere, right? Road trip. What's the old bar song? I don't care where you go. You just can't stay here. Yeah. We can't stay in this tiny little range anyway. So GTFO. That's what I got for you guys. Be careful. Be safe. Keep your eye on the clock. I'll see y'all tomorrow. No, a trailing